Picture a room full of derivatives traders staring at their Bloomberg terminals on the morning of January 29th. Coffee goes cold. Phones start ringing. Because the numbers on those screens just stopped making sense. Citigroup, one of the largest financial institutions on the planet, has engineered a situation so mathematically impossible it defies basic arithmetic. They've written contracts promising delivery of 62 million ounces of silver to counterparties who can legally demand physical metal. The problem? The entire delivery system they rely on contains only 31 million ounces of available inventory. Think of it this way. Imagine selling 620 tickets to a theater that has exactly 310 seats. Now imagine those ticket holders are showing up, expecting the seats you promised them. What do you tell the 310 people standing in the aisle? This isn't market speculation. This isn't about chart patterns or technical analysis. This is documented regulatory reality creating a trap that mathematics will eventually spring. Let's understand how one of Wall Street's most sophisticated institutions walked into a cage of their own making. The Office of the Comptroller of the Currency publishes quarterly reports that banks must file under penalty of federal prosecution. These aren't estimates or projections, they're sworn legal documents. The Q3 2025 filing reveals that Citigroup holds $6.3 billion in silver derivatives exposure. Translate that into physical terms and you get 83 million ounces of contractual obligations where counterparties possess legal rights to demand actual metal at settlement. Now here's the mathematical problem that creates systemic pressure. COMEX registered inventory, the actual pool of deliverable silver sitting in approved warehouses, totals just 31 million ounces as of January 9th, 2026. Citigroup's single institution exposure equals 2.7 times the entire deliverable supply available on the exchange where these contracts must settle. Let me give you a different framework for understanding that ratio. Imagine you're holding a voucher for a specific bar of gold locked in a vault. One day, you discover that vault operator issued 3 vouchers for your same bar of gold to 3 different people. The moment you learn this, what's your immediate reaction? You sprint to that vault and demand your gold before the other 2 voucher holders figure out what's happening. That's the dynamic building pressure toward January 29th, COMEX January Silver's final trading day, when 12,400 open contracts representing 62 million ounces must either settle in cash or deliver physical metal. Under normal circumstances, this wouldn't trigger crisis. Most futures traders are speculators hedging price movements, not industrial buyers needing physical metal. They'd accept cash settlement at prevailing market prices and close their positions. But something fundamental shifted on January 1st, 2026, that permanently altered the mathematics underlying these markets. China's Ministry of Commerce implemented export licensing requirements that rewrote global silver supply dynamics overnight. The regulation mandates that any entity exporting silver must demonstrate annual production capacity exceeding 80 tons. That single administrative requirement eliminated approximately 90% of Chinese silver exporters who collectively supplied roughly 15% of global accessible markets. We're not discussing temporary disruption or policy that might reverse with diplomatic pressure. This represents structural removal of approximately 250 million ounces annually from international supply chains. Here's why that creates catastrophic pressure on Western banking institutions like Citigroup. For decades, major banks constructed massive derivatives, positions based on an assumption they could always source physical metal when delivery demands materialized. Chinese exports provided a reliable buffer valve. When COMEX warehouses tightened, banks could access Chinese supply through various commercial channels. The pressure release valve welded shut permanently on January 1st, 2026. The registered inventory that's declined 70% since 2020 will not be replenished through Chinese supply. Not this quarter, not next year. The structural change is permanent. Think about building a bridge where your engineering calculations assume a foundation can support 1,000 tons, but you've actually loaded 2,700 tons onto that same foundation. The bridge doesn't gradually sag. It stands until stress exceeds structural capacity, then it fails catastrophically. Citigroup built their derivatives book on foundation assumptions about supply availability that no longer exist. Now watch what physical markets are telling us in real time about this supply rupture. On January 9th, 2026, spot silver in Shanghai traded at premiums of $8 to $10 above COMEX prices. That represents a 10 to 13% premium, meaning physical buyers in Asian markets are paying $86 to $90 per ounce, while paper markets in New York quote $76 to $80. Let me explain why that price gap reveals something profound about market structure breakdown. If you could buy silver contracts on COMEX for $76 and simultaneously sell physical metal in Shanghai for $86, you'd capture a risk-free $10 arbitrage profit per ounce. Traders call this free money, the kind of opportunity that vanishes in milliseconds as algorithmic trading systems exploit the gap. Except nobody can execute that arbitrage because there's no physical silver available to convert those paper contracts into deliverable metal that can be shipped to Shanghai. The premium exists as mathematical proof that paper markets and physical markets have separated into different pricing realities. Physical buyers who need actual metal for industrial production will pay $86 to $90. Paper traders who never intend to take delivery remain content trading synthetic exposure at $76 to $80. This creates an impossible mathematical trap for Citigroup and other banks, holding massive short derivatives positions. Their contracts price based on COMEX paper markets trading around $76. But if counterparties demand physical delivery, those banks must source metal from physical markets where prices have already moved to $86 to $90. Every ounce they're forced to deliver represents a $10 to $14 loss against their contract price. Multiply that loss across 83 million ounces of exposure, and you're looking at potential losses of $830 million to $1.2 billion if even a fraction of counterparties demand physical settlement. And those calculations assume Shanghai premiums remain at current levels. What happens when word spreads that COMEX delivery capabilities are constrained? What happens when industrial buyers realize Chinese supply is permanently offline and begin panic bidding for available inventory? Let us talk about the buyers who don't care about paper prices because they need actual metal to keep production lines operating. Solar panel manufacturers consume 150 million ounces of silver annually in photovoltaic applications. These aren't speculators who can choose to sit out volatile markets. They operate under binding production contracts requiring physical silver to manufacture products already sold to customers. Every solar cell requires silver paste for electrical conductivity, and there's no economically viable substitute at current technology levels. The silver undergoes chemical reactions during cell manufacturing that make recovery impossible. When that solar panel reaches end of life in 25 to 30 years, the silver has oxidized and degraded to the point where recycling costs exceed recovered metal value. This means solar manufacturers are permanently destroying 150 million ounces annually that effectively vanish from global above-ground supplies. Add electronics manufacturers using silver in circuit boards, switches, and conductors, another 70 million ounces consumed annually. Medical device makers embedding silver in antibacterial coatings, 20 million ounces gone. Total industrial consumption exceeds 600 million ounces annually, with roughly 240 million ounces permanently destroyed through irreversible chemical processes. Here's the mathematical reality that creates price floors. A solar manufacturer holding $2 billion in panel orders does not care if silver costs $76 or $130 per ounce. Silver represents approximately 3% of total panel manufacturing expenses. Even a 100% price increase barely impacts profit margins. On January 6, 2026, solar panel manufacturers in Tokyo spot markets paid $130 per ounce for immediate physical delivery. Semiconductor fabrication plants contracted silver for Q1 2026 delivery at $145 per ounce. Those prices reveal what paper markets haven't fully absorbed yet. When you need physical metal for contracted production, paper prices become irrelevant. Industrial buyers will absorb prices up to $120 to $150 per ounce before seriously exploring alternatives or redesigning product architecture. That creates a demand floor 58 to 97% above current COMEX paper prices. And those are minimum prices, not accounting for what happens when investment demand accelerates or other industrial buyers start competing for scarce inventory. Now, let me show you something that hasn't happened in 24 years, something that should make every market participant pause and reconsider their assumptions. The CFTC Bank Participation Report, dated December 2nd, 2025, revealed that U.S. commercial banks flipped to a net long position in silver futures for the first time since 2001. Think about the significance of that shift. For 2 decades, banks consistently held net short positions, betting on lower prices or hedging long physical holdings. That positioning made sense when Chinese exports provided reliable supply buffers and industrial demand remained predictable. The collective reversal of that 24-year trend tells us something profound. Banks are seeing the same mathematics we're examining, and they've concluded the smart money is now long silver rather than short. Now, let's talk about the institution that knows precious metals markets better than anyone on the planet, JPMorgan Chase. From 2012 through 2020, JPMorgan held massive short positions in COMEX silver futures, at times exceeding 200 million ounces of paper obligations. They paid $920 million in fines, settling Department of Justice charges for precious metals market manipulation during that period. The government's case documented thousands of instances where JPMorgan traders spoofed markets, placing large sell orders they'd never intended to execute, artificially driving prices down, then canceling those orders and buying at depressed prices. But something remarkable happened after 2020. While JPMorgan was paying nearly $1 billion in manipulation fines, they simultaneously began accumulating physical silver in quantities that would seem insane if you didn't understand what they knew about future supply dynamics. Current estimates based on warehouse movement analysis suggest JPMorgan now holds approximately 750 million ounces of physical silver, 750 million ounces. That's nearly 25 times the entire COMEX registered inventory. The bank that spent over a decade suppressing silver prices through paper market manipulation has stockpiled more physical metal than any private entity in modern financial history. Why would JPMorgan execute such a dramatic reversal from their largest short position ever to their largest long position ever? Because they understood before the broader market that China's export restrictions would fundamentally break the supply chains, allowing paper markets to function. They calculated that COMEX registered inventory would deplete to levels where physical delivery demands would overwhelm available supply. They recognized that solar demand would create irreversible industrial consumption at rates the market couldn't replace. JPMorgan manipulated silver prices downward for over a decade, paid nearly $1 billion in fines for that manipulation, then positioned themselves on the opposite side of the trade, betting that the same markets they suppressed will explode upward. That position flip from the most sophisticated precious metals trading desk in the world should tell you everything about what's coming. JPMorgan doesn't make billion-dollar bets based on hope or speculation. They trade on mathematical certainty derived from supply-demand analysis that most market participants will only understand months after events have already unfolded. Let's do the calculations that Citigroup's risk management team is certainly doing right now, using data publicly available through CME Group's daily warehouse reports. During December 2025, COMEX registered silver inventory declined at an average rate of 2.1 million ounces per week. This isn't a single-week anomaly. It's the sustained withdrawal pattern as physical buyers extract metal from the exchange system. At that depletion velocity, the 31 million ounces remaining in registered inventory reaches zero by March 28, 2026. That's exactly 12 weeks from January 1st, when Chinese export restrictions took effect, 12 weeks until COMEX runs completely dry of deliverable silver. Now consider what that timeline means for the March silver contract, which historically represents the largest delivery month on COMEX. March last trading day falls on March 26th, just 2 days before projected inventory depletion. Any trader standing for delivery in March will be demanding metal from a system literally days away from complete exhaustion. COMEX officials will face an impossible choice when that moment arrives. They can allow the exchange to default on delivery obligations, which would represent the first precious metals exchange default since Roosevelt's 1933 gold confiscation. Or they can implement emergency rule changes prohibiting physical delivery. Both options destroy the exchange's credibility as a functional delivery mechanism. If COMEX can't guarantee physical settlement, what purpose do futures contracts serve? They become purely cash-settled synthetic instruments with no connection to underlying physical reality. Let me walk you through the inflection points where this mathematical pressure reaches critical thresholds. January 29th, 2026 marks COMEX. January silver last trading day. Those 12,400 contracts representing 62 million ounces must settle, either through cash or physical delivery. With only 31 million ounces in registered inventory, this becomes the first major test of whether paper markets still function when physical delivery is demanded. February 1st through 3rd, 2026 represents the settlement window where January contracts actually deliver. This is when Citigroup and other short-positioned banks must either produce physical metal or negotiate cash settlements with potentially unhappy counterparties. Watch Shanghai premiums during this period. If they spike above $15 per ounce, that's your signal that physical delivery pressure is overwhelming available supply. March 26, 2026 brings COMEX March silver last trading day. March, historically, experiences the heaviest delivery volume of any contract month. If registered inventory continues depleting at 2.1 million ounces weekly, roughly 20 million ounces will remain by late March. With March open interest currently representing potential delivery of 45 million ounces, the mathematics simply don't reconcile. Either prices surge to discourage delivery demands, or COMEX implements emergency intervention measures. September 26, 2026 represents the true endgame. By September, we'll have 9 full months of zero Chinese supply flowing into global markets. Every ounce consumed by solar manufacturers, electronics makers, and medical device producers from January through September will be permanently removed from circulation. The September contract settlement occurs with depleted inventories, exhausted Chinese supply buffers, and 9 months of industrial buyers competing for increasingly scarce metal. If COMEX registered inventory somehow survives until September, which seems mathematically improbable at current depletion rates, the September contract will face delivery obligations with virtually no supply cushion remaining. That's the moment when paper and physical markets either converge through explosive price appreciation or separate completely as paper contracts trade at permanent discounts to physical metal. Let's examine what happened the last time a major institution concentrated too heavily in a single derivative position. Bear Stearns collapsed in March 2008 when their mortgage-backed securities exposure exceeded firm equity by a 3-to-1 ratio. They'd concentrated so heavily in a single asset class that when prices moved against them, losses consumed their entire capital base in days. The firm that survived the Great Depression, that weathered every market crisis for 85 years, vanished in a single week because they bet too large on one trade. Now examine Citigroup's situation through that same analytical lens. They hold $6.3 billion in silver derivatives, 66% of the entire U.S. banking system's precious metals derivatives exposure. One institution representing 2/3 of total industry exposure. Does that concentration structure sound familiar? It should, because we've watched this exact pattern destroy major financial institutions before. The critical difference is this. Bear Stearns had roughly 18 months of mounting pressure before final collapse. Citigroup has 12 weeks until COMEX inventory mathematically depletes at current withdrawal rates. The timeline is compressed. The mathematics are unavoidable. And the deadline approaches whether market participants acknowledge the reality or not. Let's discuss where prices could reasonably move when physical squeeze dynamics take control, using historical precedent as a framework. The Hunt brothers' silver squeeze in 1980 drove prices from $6 to $49.45 in 12 months, a 725% gain. That squeeze occurred when industrial demand represented only 40% of total silver consumption compared to 60% today. The Hunts succeeded through speculative hoarding, accumulating roughly 200 million ounces and creating artificial scarcity. When their positions unwound, that metal returned to the market. The 2026 situation operates under fundamentally different dynamics. The scarcity isn't artificial. It's driven by permanent supply removal through China's export ban, combined with irreversible industrial consumption. When solar manufacturers consume silver in photovoltaic cells, it's destroyed forever through chemical degradation. If a 1980s squeeze driven by speculation and temporary hoarding produced 725% gains, what could a squeeze driven by permanent supply deficit and industrial panic reasonably target? The mathematics suggest prices could reach $200 to $267 per ounce, representing 163 to 251% gains from the current $76 baseline. Are those projections guaranteed? Of course not. Nobody can predict exact price targets with certainty, but they're mathematically defensible based on supply-demand fundamentals that are more severe than 1980, with industrial buyers demonstrating far less price sensitivity than speculative traders. Here's what you need to understand as we approach these critical deadlines. Citigroup made a calculated bet that paper markets would continue functioning as they have for decades, where most contracts settle in cash and physical delivery remains the exception. That bet relied on assumptions that have been systematically invalidated. Chinese supply would remain accessible. It's permanently offline. COMEX inventories would stay sufficient. They're depleting at crisis rates. Industrial buyers would accept paper price discovery. They're paying 13% premiums for physical. And perhaps, most telling, JPMorgan, the bank that understands precious metals, markets better than anyone, has positioned itself long with 750 million ounces of physical metal, while Citigroup stayed short with 83 million ounces of exposure. Citigroup's $6.3 billion derivatives position represents a mathematical trap of their own construction. They've promised to deliver 83 million ounces from an exchange system holding 31 million ounces of registered inventory, when Shanghai buyers pay $86 and COMEX quotes $76, the paper game is ending, whether banking institutions acknowledge it or not. February 1st isn't the collapse. It's the first warning shot, the first margin call signaling that contractual obligations are colliding with physical reality. By March 28th, when registered inventory mathematically depletes to zero at current withdrawal rates, the questions won't be theoretical anymore. They'll be immediate and unavoidable. How do you deliver metal that doesn't exist? How do you maintain futures market credibility when physical delivery becomes impossible? The banks that repositioned early, that recognized Chinese export restrictions, would break the supply chain models underlying paper markets. Those institutions survive this crisis and profit enormously from the squeeze. The banks that hesitated, that relied on outdated assumptions about supply availability and delivery patterns, become case studies in how quickly market structure fails when physical reality diverges from paper promises. The squeeze isn't driven by speculation or conspiracy. It's driven by mathematics, regulatory changes, and industrial demand colliding with finite supply. The timeline is predetermined. The pressure is building, and someone will pay an enormous price for betting against physical scarcity in a market where supply is permanently constrained and industrial demand is irreversible. February 1st begins the countdown. By March 28th, we'll know whether paper and physical markets can still coexist or whether they've separated permanently into two different realities with two different price structures. The mathematics suggest the latter. History suggests the pressure releases explosively rather than gradually, and Citigroup's derivatives book suggests they're standing in the wrong place when that pressure finally releases.